Without any true solution in the offing, Europe's debt problems still causing headaches for the banks once again. Financial stocks have taken a beating over the past month, so much so that the cost of insuring senior bonds of European banks against default has surged to a record. You can just see it from this chart how much credit default swaps have increased in just the past few months. Look at that. Well, to help explain how we should respond to these developments and assess the challenges facing financials, I'm joined by Simon Ballard, senior credit strategist at RBC Capital Markets. I mean, Simon, you saw the chart there, a pretty remarkable rise. What's behind it, and is it set to continue?
I think it's set to continue. Interestingly enough, I think it's probably the one time that I would agree with Angela Merkel that the Eurobond isn't the solution to get the way out of this. But as you say, financial debt has been escalating in terms of the prices paid. Senior sub at about 189 basis points, 190 basis points this morning. That's actually inside the extremes of early 2008 when it went over 200 basis points. But you've seen a significant underperformance of senior bonds over the last couple of days, last week or so, on the back of all this. So I think we've got a lack of sort of funding. The primary markets are effectively shut. And this could be sort of the transition mechanism from the sovereign debt crisis through to the broader macroeconomic problems if we continue to see the banks being challenged to be able to fund themselves in the broader credit markets going forward. Hence our up-in-quality strategy of sort of well-diversified banks remains very much sort of at the forefront of our investment strategy.
It does. So tell me a little bit more about that then. You're still investing in European banks?
Yeah, no, absolutely. I think in banks and in non-financials as well, there's still fundamentally there are arguments to be invested, but it's increasingly up in quality. People are increasing their cash holdings, their capital preservation focus is much more astute than it was recently, of course, and that's natural. But within the financial space, look for strong, well-diversified banks, those that aren't just dependent on sort of the domestic retail banking business, but those have geographically diversified earnings. So the solid, well-capitalized corporates, the well-capitalized, and those that have more flexible funding within the financial space.
But we do seem to be seeing this renewed uncertainty weighing on the banks right now. We saw a sell-off in the past few weeks, and then this report that in the Wall Street Journal that US regulators are looking into the local operations of European banks in the States. Is all this concern justified?
Well, I think probably it is, because we've seen where we were in 2008 and the volatility that hit the financial system. While sovereign yields remain as high as they are, then it's very, very difficult for banks to be sort of actively funding themselves through the capital markets, and this raises questions over the 6, 8 months, 12 months ahead as to how they're sustainably going to keep themselves funded, and that's why we're reflecting the market. Yes, there's been an overreaction, I think, in terms of the broad impact that we've seen. We've seen so huge amounts of volatility, but at the same time, let's not belittle the potential impact that the sovereign debt crisis that we're going through today could have on the broad, and will have, we believe, on the broader macroeconomic climate.
But you're still investing in the banks?
We're still investing. The interest rates remain low, but again, it's very much name by name. In a low interest rate environment, you want to get some incremental yield. It's not a question of chasing yield further and further down the quality curve. It's a question of picking your spots and making sure that your default risk is as minimal as you can over the course of your investment.
Simon, it sounds like you're describing a very fragile situation. What would it take for interbank lending to freeze for us to see a situation where banks stop lending to each other, liquidity dries up, and you start to think about echoes from Lehman?
Yeah, I mean, without wanting to sort of be the doomsayer, I mean, that is the big risk at the moment. If we continue to see an inability of sort of the authorities to address the underlying debt situations between the periphery and the core, and more broadly sort of in the US and elsewhere, where it's a sovereign debt, it's a global sovereign debt problem rather than just European, then you will probably start to see counterparty credit risk concerns starting to rise, and that in itself is what's been driving or sort of impeding the primary market for financials and banks over the last couple of months. That will continue.
But I suppose over the last few years, particularly since Lehman, banks have had time to strengthen their balance sheets and to also look at the extent of risk that is out there. We do have some idea of how exposed they are to sovereign debt.
Yes, absolutely. We've got a much greater, we believe, level of transparency. At the same time, we've got Basel III and the capital regulatory requirements that is bringing. So the banks are being challenged from all sides at the moment. On the one hand, through Basel, they're going to be increasing their capital ratios and their fundamental picture, if you wish. At the same time, they've got sovereign yields, which are very challenging, certainly for the peripheral Eurozone banks, to fund themselves sustainably over the medium term.
Simon Ballard, Senior Credit Strategist, RBC Capital Markets. Good to talk to you.
Thanks
so much for coming in.